In this video, we're going to talk about debt covenants and some restrictions that lenders put into lending agreements when a firm borrows money through a bond. So when we think about a bond, we've got the lending agreement. Now, obviously, the agreement is going to have things such as the maturity date. It's going to have the interest rate that's to be used to compute interest. So, interest rate. It's going to have things like that. And that's what we normally think about when we think about a bond or a lending agreement. But there are also some things that the lender is going to insist be put into the agreement to protect its own interests. And these things are what when we talk about debt covenants and restrictions, that's what we're talking about. So it's some kind of provision that's put into the lending agreement that restricts or kind of mandates the way a firm has to act in a given situation. So it's easier illustrated with an example. So let's just say one common example would be that the firm can't take on more debt. So firm can't borrow more. Now you might think, well, hey, this doesn't make any sense. You know, what does this lender care? They have their own agreement with the firm. Why do they care whether the firm borrows more money from somebody else? That's not their business. Well, the thing is, so let's take this original lender. So we've got, let's say, lender number one. Let's call that. That's the original lender. And that lender gives, let's say they give $1,000 to the firm. And they think, okay, based on this firm's riskiness, you know, we've looked at this firm. We think they're this amount of risk associated with this $1,000, with their assets, with their income stream, and we're going to give them an interest rate of, let's say, 7%. Now this is based on risk, right? If they thought there was more risk, they would have given a higher interest rate, right? Or maybe not made the loan at all. But now, lender number two comes along. Now this is assuming that there's no restriction on whether the firm can borrow more. Lender two comes along. After the firm got the $1,000, the firm goes and borrows money from lender two and borrows $100,000 to a firm. Now, what just happened to this initial $1,000 that was given to this lender? Now, you might say, well, hey, wait a minute. This lender has priority because they lent to the firm first, so they have nothing to worry about. But remember something. So this firm is going to be paying interest on this $100,000 as well as the $1,000, right? And what is the interest going to do? It's going to eat into this firm's profits, into their cash flow, and it's going to make this firm's original loan to the firm is going to make it a lot riskier. It's a lot less likely when this firm goes out and borrows an additional $100,000 that it's going to be able to make the interest payments, that it's going to be able to repay the principal to the original firm. So the firm, lender one, when this lender goes and lends to this firm, they say, okay, we've assessed a certain level of risk. And what they want to do by restricting whether the firm can borrow more is ensure that the firm can't immediately then go out and make itself more risky, right? So another type of restriction you might see, and this is kind of related, would be a restriction on dividend payments. So it might say can't issue dividend. The lender might tell the firm you can't issue a dividend unless, let's say, you have a net worth of at least $10 million. So unless net worth is greater than $10 million. So again, you might be wondering, well, what does the lender care whether the firm is issuing dividends? Well, remember, let's just take a really extreme example for a moment. So let's say that we've got the lender. The lender loans $50 million to the firm, right? And then the next day, the very next day, the firm goes and takes that $50 million and issues a liquidating dividend to all the shareholders and just tells the lender, hey, sorry, we're bankrupt. We just issued a liquid. And you might say, hey, well, they can't do that. That's dishonest. Well, that's why we have this feature that they have a dividend restriction. Now, in most cases, obviously, we're not thinking about something where the firm would do something so ridiculous, although I wouldn't put it past a firm if they could do it. But what we're really talking about is an issue where a firm might be in a position where they really want to issue a dividend and they don't want to have a dividend cut because they've had a dividend for so long, for years. But in reality, it's not best for the lender that the firm be issuing dividends, because those dividends, that's money that could have been used to pay interest in the next period. So the lender is just saying, look, we want to make sure we get our principal and our interest payments. And so unless you have a net worth of at least $10 million, you shouldn't be issuing a dividend. So the lender can kind of write in these restrictions, and they're basically trying to protect themselves. Now, in addition, when they come up with these kind of rules, like, okay, well, we've got this net worth restriction on dividends. Well, now the lender can go and rewrite the accounting rules. So they can rewrite the rules of how to compute things like net worth, right? For example, let's take, instead of net worth, let's think about assets. So the lender might say, okay, well, when we compute assets, for purposes of there's something in your maybe return on assets or something like that, has to be a certain amount, otherwise so there's something regarding assets in a lending agreement and you have to compute it. Well, you might say, well, hey, look, we follow GAAP, we're a publicly traded firm, we'll just take assets from the balance sheet. And they say, no, wait a minute, we're going to calculate assets differently. So we're just going to have assets be GAAP assets, but we're going to make an adjustment. They're GAAP assets minus goodwill. And I think, well, why would they take out goodwill? Well, goodwill doesn't really seen as having any value. It certainly doesn't have any value in a bankruptcy proceeding. It's just something they said, look, when we calculate assets, we don't want to factor that in. We just want every other asset, or maybe just intangibles in general, they get rid of. So you just get rid of intangibles. And so the lender can go and make these kind of adjustments and basically rewrite GAAP or rewrite. Now, this doesn't affect how the firm would actually be financial reporting, right? This isn't the financial statements that are changing. Of course, the lender can't require a firm to report outside GAAP in its financial statements. These are just for the purposes. So rewrite the rules just for the purposes of calculating these of computing these different restrictions. And the lender's free to do that. And, well, you say, well, the borrower, that's not fair to the borrower. Well, the borrower can just say, look, I don't want to sign the agreement. I don't want to borrow the money. So the lender's just putting these things in place to protect themselves so that the firm doesn't make itself riskier or make the chances that it'll be able to repay the principal and interest much riskier after it's taken the money.